I'm just clicking on go live.
Okay.
Yeah. So we are live. Welcome everybody. Thanks a lot for joining us on a Wednesday evening again for our monthly AMA webinar. I am Eesha Gupta, part of the Gulaq team, and we have Vivek, who's the investment head at Gulaq, joining here with all of you today to answer all your queries about Gulaq portfolios, markets. We have received lots of questions already in the Google form, and we'll be trying to answer as many as possible today, along with the questions from the chat box on YouTube. So let me quickly share my screen and take you through the presentation, the rebalance update that we have for the day, for this month. Just a moment. Okay, Vivek, please let me know if my
It is visible.
it's visible.
It's just coming up.
Okay, okay. Is it visible now, Vivek?
No, I can just see a black screen.
Okay.
Yes, now it is visible. Yeah.
Perfect, perfect. Right, so let's begin. The agenda, we'll talk about St Gulak, the rebalance update, and then we'll open the floor to Q&A. Very quickly, just a quick introduction about ST. We have been around since 2008. We are operating in 6 countries, and we are pioneers in creating leading investment and broking products using computer science and analytics. We do have a PMS service of our own, which caters to high net worth individuals. And we have another division in the firm called Gulaq, which is the retail investment advisory arm of ST. So Gulaq creates sophisticated quantitative algorithms using which we give advice to retail clients like you and me for portfolios which start with a minimum investment of 24,000. We launched in 2020. We have a SEBI registered investment advisory license, and we have served 20,000 plus clients till date. This is in the last 2 years. Our strategies are multi-factor algo-based strategies about which Vivek will be talking in more detail in the Q&A segment. Okay, now moving on. Moving on to the next slide, this is our team. Of course, a lot of you would be knowing about Mr. Sandeep Tyagi, who also held the investor meet over this weekend in Gurgaon. He's the founder and CEO of ST. He has done a BTech from IIT Delhi and MBA from Columbia Business School, and he has 30 plus years of experience in portfolio management, analytics, and consulting. Vivek Sharma, who's the investments head at Gulaq and a director in ST, is a BTech and MTech from IIT Kharagpur and has over 20 years of experience in trading and investment management. Eesha, myself, I'm a business development manager at Gulaq. I've pursued my MBA from ISB, the Indian School of Business, and I have 6 plus years of experience in consulting, research, and the financial services domain. Just few disclaimers like every time, because we are a registered investment advisor with SEBI. So we need to inform all our clients about the risks associated with investing in the markets and showcase a lot of important details about ourselves to our investors. So please have a look at all the important disclaimers. Now moving on, just a quick update on the latest blogs that we've published this in the last month. The first one is about halo effect. I would urge you all to go through it. It's a very interesting topic if you do not already know about it. And the second is a 10-year performance that we have done of the different large cap, mid cap, and small cap. So if you have any questions on the same, happy to answer those as well. And as you know, we have a website, gulaq.com, which you can see. The blogs section of gulaq.com will have all the blogs that we have written over the months, one of which in January, we also do a blog of our performance of the past year. So if for anyone who's newly associated with us and is interested, please feel free to have a look, visit the website, even make use of the tools that are present. There is a risk calculator. So we have always been requesting our clients or potential clients to figure out their risk appetite before deciding where to put their money. So the risk calculator is a great tool that we have for you to assess your risk appetite. Okay, now moving to the rebalance update for the month. As you would see, from Jan to March, our allocation towards large cap has increased from 16% to 26% because we've had a lot of, we've found more opportunities in this segment. Mid cap has also increased slightly, but small cap, the allocation towards small cap has reduced slightly. So this is the detailed, here we have detailed our allocation towards the different market caps. Moving to the sectoral allocation, of course, if you look at the last column on the screen in the table on the right, if you see March as compared to BSE 500, which is our benchmark index, you would see that we have been bullish on healthcare, energy, utilities, and we have been bearish as compared to the benchmark in the financials sector and in consumer staples and materials. So consumer staples, we had around 10%. We were on similar lines with the benchmark, but we have removed our allocation towards the sector in this month's update. So this has been the sectoral allocation of our portfolio. Moving on, just to talk about the different gears for people who are newly associated. Our gears are based on different risk levels. The analogy of a car. So if you're driving on a clear road with good weather, you are very comfortable driving at a higher speed, you will go full on. You will put your car on the 6th gear and you will drive on full speed. So that is equivalent to a gear 6 where we have 100% equity, because 100% equity means high risk and also high return. So if you're an aggressive investor, this gear 6 portfolio is the most suitable. Then we come down till gear 5, 4 and gear 3. 3 has the maximum amount of debt that we are offering, which is 60% debt and only 40% equity. So this is more suitable for people who are who are a little risk averse. For example, when you're driving, there is, let's say you're on a bumpy road or you're driving on the mountains, the weather is not good, there are thunderstorms. So you would want to drive a little carefully, a little slower. So this particular gear has the same philosophy. It has more of debt and less of equity so that the risk you take is less, which means the returns expectations from this portfolio would also be lesser than that of higher gears. So these are all the gears for people with different risk appetites. And we always urge our clients to invest only in one of the 4 gears. Don't have your money deposited in 2 gears at the same time, because they're all for different investors with differing risk appetites. Coming to the returns, because this is a question we have received a lot in our in the registration form for this webinar also. People wanted to know about our returns and what has been happening lately. So as you see, we have been live on small case since 2020. The benchmark is the BSE 500, the multi-cap index. As you see, we have outperformed BSE 500 since the time we have launched. We launched in 2020. So our CAGR since 2020 is 58%, which means every year on average, we have given 58% returns. Similarly, if you see 3-year, 2-year, 1 year, and even the monthly returns, we have consistently outperformed the benchmark except for the 1 month, which was the month of February. But Vivek will be talking more about when he takes the Q&A on, what should be the expectations and what happens when we underperform. So in this table, you see a snapshot of our returns, which are always overperforming the benchmark. But there have been periods in the history of Gulaq portfolios where there have been a few months that have seen underperformance as compared to benchmark, which currently is not visible. So if you're a long-term investor, you would see that in the long term, the portfolio is always giving positive and it's generating alpha. So Vivek will be covering more on that. These are the gear 6 returns. Now we have investors who've complained that, hey, we are also giving the same money. We have invested in gear 5, gear 4. So why aren't you showing returns of those portfolios? So here we are with the returns of the other portfolios as well. Again, you will see consistent outperformance in all the years across all time periods, except for the last month. Now, an important point to note here is that the benchmark here changes. So on small case, they have only equity-based benchmarks, but we have created a blended index benchmark. By that, what I mean is if gear 5 is a 80% equity, 20% debt portfolio, in benchmark also, we have considered 80% returns of BSE 500 and 20% FT returns, so that we have a like an apples to apples comparison. So you will see the benchmark in each slide will change, the returns will change. Gear 5 will have a benchmark which has the same asset allocation. Now over here, these are the returns for anyone who has been our investor in year 5 or is considering investing money in year 5. We have year 4, which was launched only in September 2022. But you will see that so a lot of people, tell us that, hey, you're live since May 2020. The markets rose substantially after that. So of course, your CAGR will be high. But then again, if you look at year 4, which was launched only in September 2022, its CAGR is also 54%. And the best way to look at any product is to not look at its CAGR in isolation. You should always compare it with the benchmark. So whether it is year 6, which has been live since 2020, or this year 4, which is since 2022, you should always compare it with the benchmark. This is true for our products or for mutual funds, PMS products, or any other company's products that you're evaluating. So this is the snapshot of our returns for year 3. And this is everything put together. So if anyone wants to have a look at the returns, you can rewind the video. We are live on YouTube. All of this will stay for anyone who's wants to investigate, look at them in more detail. And now a quick slide showcasing the returns on an annual basis. So on the right side, you will see a chart which shows that in each year, what were the annual returns given by year 6. And you will see the annual returns also we've consistently outperformed in 2022, where the benchmark was flat. Gulaq gave a 21% return. And on the left, you see that 100 rupees invested in May 2020 would have become 266 if you were in the Nifty multi-cap, whereas they have become 621 if you are with Gulaq Gear 6. Again, this is the 100% equity portfolio. Had you invested in a lower gear, the returns would have been lower, but so would have been the returns of the corresponding benchmark. Now, I think this was all about the rebalance update. We will open the floor to Q&A, and Vivek, I would invite you to take the initial questions that we have received in the registration form, after which we can look at the questions in the YouTube live. I will just stop sharing my screen, Vivek, so that you can carry on from here. Just a moment. Yeah, Vivek, you can share your screen now.
Okay. Yeah, is my screen visible?
Yes, Vivek, now it's visible.
Okay. So we have divided all the questions that we got in these 7 categories. One is related to methodology, rebalancing, about past returns, investment guidance, market related, Gulaq future plan, and the PMS. Right. So I'll be taking this one by one. First is regarding methodology. These are all the questions that we got related to our methodology. What is the process behind stock selection? How is Gulaq minimizing returns in current market? What's the strategy related to current in case of market correction? Factors being considered and USP. Yeah. So regarding our methodology, it's a multi-factor model in which what we are considering is we are considering a lot of technical factors, lot of fundamental factors. So roughly around 40% of the weightage is being given to these fundamental factors. And we also have weightage to global and local macro factors like inflation, like GDP growth rates, and prices of essential commodities. All of this is taken into account while selecting or giving weight to a specific stock or to a specific sector, right? And if all things being equal, a stock with better fundamentals gets more weightage, but each stock gets a aggregate score considering all of these 3 kind of factors, which are technicals, fundamentals, and macro factors. And only then a stock gets selected. So it might so happen that one of the questions was also related to high PE. What could actually happen is a stock with high PE as compared to low PE. What could happen is obviously the low PE stock might have better, it might be better valued in terms of it is undervalued stock, but a high PE stock might be much more in momentum. So it might be getting higher technical weightage or higher score in the technicals, and relatively lower score in the fundamentals, but overall the aggregate score, because it is high, because of these technicals, it would get selected in our portfolio. But yeah, we do take into account the fundamentals also while selecting a stock, right? Again, this methodology has had about 3.5 years of successful live track record. And obviously, we have tested this with 12 years of back tested data. The important thing is this is a very, very flexible methodology. We do not give any specific bias or weightage to a specific sector or a or market cap. Depending on where we find the opportunity, whether it is in large cap, mid cap, or small cap, the algorithm automatically shifts the allocation to that specific sector or even factors. So what happens is, let's say if the markets are too volatile and our algo says that maybe we are expecting some sort of correction, what would happen is it would reduce the risk. And the way we'll reduce risk is move on to the safer factors like undervalued stocks or high quality stocks or the stocks which are least volatile. And eventually what would happen is the weightage will get shifted to large caps because most of these stocks would be in large cap category, right? And that is what we have been seeing over the past 3 to 4 months, that the large cap allocation has been going up every month for the last 3 to 4 months. That is how we reduce risk in our portfolios. And rebalancing frequency, again, there were a few questions regarding rebalancing. But rebalancing frequency of month to month, actually, it helps us stay up to date with the current market conditions. Okay, that's about the methodology. Now, let me take few more questions that we got. Why are we keeping less than 2% allocation to certain stocks? So what we have seen is if we remove all the stocks that have less than 2% of the allocation, our number of stocks would reduce to maybe about from about 12 to maybe about 8. And that does not really impact the return so much, but it does increase the volatility of the portfolio. So that is one advantage we have seen, that having about 12 to 15 stocks helps us in controlling the volatility as compared to when we actually remove these stocks having much smaller allocation. Yeah. There were quite a few questions regarding this. Does your algo factor in the latest news while stock selection? Or the second question is, would the results of current election be factored in? Now, this is something that we have researched a lot, spent a lot of time earlier also, and we'll be spending more time in the future also. So what we have done is, obviously, we don't want to get into human intervention, because there was a question that why don't we intervene if we have seen any specific news regarding a stock? Why we don't intervene? So again, we really don't want to do that. That is not our core capability, right? Our core capability is the way we select stocks, which is taking a lots of data and analyze that data to select stocks and make a very good portfolio out of those specific stocks. So use the data-driven methodology to select stocks. And if we start taking these human discretionary calls, which we have never done in the past, frankly, you don't want us to do that, because that is really not our core capability. So it's something like, let's say, a fund manager, if you have invested in a large cap fund, do you want that fund manager to start picking from stocks from, say, micro cap category? Even though there might be much more opportunities in the micro cap category, but that fund manager who has expertise in picking large cap stocks, you really don't want to sidestep and extend his mandate and start selecting stocks from micro cap, right? So you really don't want to do that. And similarly with us, our core capabilities using data-driven methodology to select stocks. So we'll never get into human intervention, but yes, but the other way to do it is have your algos keep a track of all the news and all the discussion that is going around a specific stock or a sector on social media platforms, and use that sentiment analysis uh, as one of the factors. So we have done this research in the past, and what we have seen is we haven't really found any meaningful alpha from this specific factor, right? So that is why that specific factor has not been included in our portfolio. What it has shown is at times we are able to pick few stocks which do better, which maybe we are able to avoid these falling stocks. But at other times, again, it has worked against us also. So net, that really hasn't given our portfolios any advantage, and that is why we do not have that specific factor in our portfolios. But yeah, we keep researching new ways of accommodating those alphas or those factors rather. And as and when we figure out that we are able to do uh, justice and make sense of these news or the social media chatter, we'll definitely include it. But as of now, we really don't have any meaningful way of including that as a factor, right? So again, this also answers the question related to election, that we really won't be taking election into account or election results into account while constructing our portfolios. That's not uh, how we operate, right? Why are high PE stocks? I think I've answered that with the SEBI guidelines of restricting investment into small and mid cap for mutual funds. Yeah, so as it's mentioned here, those regulations are really for mutual funds and they do not apply to us. But yeah, we do have one factor in which we track what are the inflows from mutual funds or from other institutions or even FIAs into these specific stocks. So we do track that, and that if it is having any impact, it will be captured in those factors. But directly, it will really not have any impact on Gulaq portfolios. Okay, so I've answered all of these. Let me move on to the next one. Methodology I've covered. Okay, so these are the questions related to rebalance that we got. So can you please explain the rebalancing process? So what we do in rebalancing is every month, at the end of the month, when the market closes, we have all the data, all the updated data, be it related to new results that some companies might have announced, or a lot of data related to our economy, how is it doing, or inflation, or related to that specific stock, the data about their price, about volumes, if that stock is in FNO category. So all of that data we take into account and then run our algorithm to see which are the best stocks that are suited for the current market conditions. And we actually include those stocks and exclude those stocks which are not really uh, in the aggregate score based on all the multiple factors, 130 factors that we consider, which are not doing well. We exclude that and only pick up the top stocks. That is what we do in the rebalancing so that your portfolio is up to date to perform in the current market conditions, right? Why not have rebalancing on the need basis? Again, this is something that we have tested in the past, and the best results that we have seen is actually when we do rebalancing on a monthly basis. Lately, we have seen huge slippage cost. Can you please explain us the reason? Again, see, there's no reason as such. Sometimes if the markets are volatile when you are rebalancing, then you might encounter one of the things that you can do while rebalancing is, because the best liquidity is towards the end of the market, which is from 3 o'clock to 3:30. So our suggestion would be anyone having slightly bigger portfolios should definitely rebalance towards the end where the market is much more liquid. But this time around, I also observed while rebalancing what had happened this time is some of the stocks that we had sold actually kept on going down. Sorry, they actually went up, whereas some of the stocks that we bought actually throughout the day they came down. So that is not really slippage. The slippage is at the time when you are executing trade, what was the price at that point of time versus what you got, right? That is the slippage. The slippage is not really what happens after the execution. So if we have bought a stock and if it comes down, that is not really slippage, right? So yeah, because some of the comments I saw was related to that also. I just wanted to clarify and differentiate what is slippage versus what is not. So yeah, the best way to avoid that higher slippage would be try to rebalance during the end of day, maybe about last 30 to 40 minutes. That's when we have the best liquidity, or even at the beginning about when the market opens after 5 to 10 minutes, we start seeing good liquidity and it remains there for about 30-40 minutes. So maybe from 9:40 to 10:30 is the time you can rebalance your portfolios.
Vivek, just would like to add, there is a comment in the section in the chat box asking us to
Yeah,
talk in Hindi. तो अगर हम थोड़ा हिंदी इंग्लिश मिक्स में बात करें, आई थिंक वो अच्छा रहेगा.
sure. I'll try to answer a few questions in Hindi.
Sure.
Okay, the next question is, can you give orders to exit specific stock? तो ये क्वेश्चन ये है कि अगर ड्यूरिंग द मंथ कोई एक स्टॉक परफॉर्म नहीं कर रहा है तो हम उसे सेल ऑर्डर क्यों नहीं देते हैं? तो एज आई एक्सप्लेन्ड अर्लियर कि हमारी जो रीबैलेंसिंग मेथडोलॉजी है दैट वर्क्स बेस्ट, वो तभी बेस्ट वर्क करती है जब हम मंथ के एंड में रीबैलेंस करते हैं. अगर हम किसी भी टाइम रीबैलेंस करेंगे तो वी हैव टेस्टेड दिस कि जब भी नीड बेसिस पे, जब भी कोई एक स्टॉक बहुत ज्यादा ऊपर चला जाता है, बहुत ज्यादा नीचे चला जाता है, तब हम रीबैलेंस करें तो उसमें दो प्रॉब्लम्स हैं. वन इज ऑब्वियसली कि उसमें रिटर्न्स बहुत अच्छे नहीं आते, और दूसरी प्रॉब्लम जो उसमें होगी वो प्रॉब्लम ये होगी कि अगर हम किसी भी टाइम रीबैलेंसिंग दे देंगे तो अभी हम मंथ के स्टार्ट में देते हैं, तब भी बहुत ज्यादा कस्टमर्स हैं जो जिनके पास टाइम नहीं होता और वो मिस कर देते हैं रीबैलेंसिंग, और वो कुछ दिन बाद ही कर पाते हैं. अब अगर हम मेथोडोलॉजी चेंज करके ये कर देंगे कि हम मंथ के किसी भी दिन रीबैलेंसिंग दे सकते हैं, तो उससे मेरे को लगता है बहुत ज्यादा इन्वेस्टर्स ऐसे होंगे जो वो रीबैलेंसिंग मिस कर देंगे बिकॉज दे आर नॉट एक्सपेक्टिंग कि रीबैलेंसिंग उस टाइम आएगी. तो दैट इज अनदर ऑपरेशनल रीजन जिसकी वजह से हम वो नहीं करना चाहते. बट द मेन रीजन इज द रिटर्न्स, दैट वो बहुत ज्यादा एफिशिएंट तरीका नहीं है एज कंपेयर टू जो अभी हम फॉलो कर रहे हैं विच इज मंथली रीबैलेंस. अगेन एक क्वेश्चन ये था कि रीबैलेंसिंग फ्रीक्वेंसी मंथली ही क्यों, वो वीकली आप क्यों नहीं कर सकते या क्वार्टरली क्यों नहीं कर सकते? सो वी हैव सम डेटा रिलेटेड टू इट. So this is the returns, and if you see the overall returns or rather any frequency, any time period, इसमें अगर आप देखते हैं तो बेस्ट रिटर्न्स जो हमें मिलते हैं वो मंथली फ्रीक्वेंसी पे ही मिल रहे हैं. दिस इज द बैक टेस्टेड डेटा जो हमने जैन 2012 से अब तक का डेटा लेके बैक टेस्ट जो किए हैं, उसके बेसिस पे जो हमें बेस्ट रिटर्न्स मिल रहे हैं, वेदर वो लास्ट 1 ईयर में देखे, 3 ईयर या 5 ईयर या 10 ईयर, हर एक टाइम पीरियड में जो हमें बेस्ट रिटर्न्स मिल रहे हैं वो मंथली रीबैलेंसिंग पे ही मिल रहे हैं. क्वार्टरली में भी वो थोड़े से कम हो जाते हैं, और वीकली में भी वो रिटर्न्स कम हो जाते हैं. तो द बेस्ट रिटर्न्स अगेन is for monthly, and that is why for now we are sticking with monthly. Okay, next question is there some analysis which shows impact on returns based on timing of rebalancing? What is the recommendation for proper rebalancing? तो टाइमिंग एक तो मैंने जैसे बताया कि अगर आपका अकाउंट थोड़ा सा बड़ा है तो आप स्टार्टिंग के 1 घंटे या लास्ट के 1 घंटे में रीबैलेंस करें. Second is the number of days. So we did some analysis on this and I shared in the previous webinars also. तो हमने उसमें क्या किया था कि if you rebalanced, let's say we pushed out our rebalance yesterday after market close. So today you were to rebalance. So if you rebalance today versus with a lag of 1 day, which is tomorrow, or lag of 2 days, which is day after tomorrow, and so on and so forth. तो हमने जो देखा था कि अगर आप पहले 2 से 3 दिन, 3 दिन एक्चुअली इज द थिंग कि अगर आप पहले 3 दिन में रिबैलेंस कर लेते हैं तो उससे बहुत मीनिंगफुल इम्पैक्ट नहीं होता है. रिटर्न्स आर मोर और लेस सिमिलर. बट 3 दिन के बाद जब आप फोर्थ, फिफ्थ या सिक्स डे या उसके बाद जाते हैं तो रिटर्न्स बहुत ज्यादा ड्रास्टिकली रिड्यूस होते हैं. तो our suggestion is obviously to try to rebalance on the first day, but if you are unable to do that, even first, second, or third day, it really won't matter so much in terms of returns. So try to rebalance in the first 3 days for sure. How to avoid additional costs at the time of rebalancing and one-time investment. I think rebalancing, I've already told, one-time investment, because we are rebalancing at month start. तो अगर आपकी वन टाइम इन्वेस्टमेंट जो है वो मंथ के लास्ट वीक में आ रही है, तो लास्ट वीक में आप पोर्टफोलियो लेंगे और विद इन 1 वीक आपको फिर से रीबैलेंस करना पड़ेगा. तो आई थिंक दैट इज नॉट, that is something we won't recommend. So try to, if you are investing, maybe try to do investment in the first 20-25 days or so. But वो last week में है, तो maybe you can wait for a week so that जब आपका rebalancing हो जाएगा तो you put that new money in the new rebalanced portfolios. Can you share suggested buy price? Again, in this, see, there is no suggested buy price, and we haven't done any analysis as to what if a stock has gone up by 5 or 10% or gone down by 5 or 10%. You missed that rebalance. We haven't done any specific stock specific analysis, right? So yeah, so there's no recommended buy price, but again, as I've told, if you are able to rebalance in the first 3 days, you're doing just fine. Some of the stocks obviously might run up, but some of the stocks that you wanted to buy might come down also. So overall, net, it really doesn't make too much of a difference in the first 3 days. Is monthly rebalancing tax efficient? So this is, I think we have discussed this. If you compare, obviously monthly rebalancing means, and the kind of rebalancing that we have, almost all our profits are in short-term capital gains, which is taxed higher than long-term capital gains tax. So, but again, as I said, in the last slide, I showed quarterly rebalance. If you look at yearly rebalance, it is even less efficient in terms of returns. So if you're doing yearly rebalance, we might avoid the short-term capital gains tax, and we might just have to pay the long-term capital gains tax. But at the same time, your returns overall are also lower, right? So there's no way around taxes. I think that is something that we'll have to bear. Another way is obviously mutual funds, which are very, very tax efficient in nature. The mutual fund manager can keep on doing the rebalancing internally. But as an investor in mutual fund, you don't need to pay those taxes if you are holding on to those mutual funds. But in this specific structure, short-term capital gains tax would apply, and there is no way around it. Lastly, why partial exit and not full exit from certain stocks allocated less than 1%? Again, the reason is what I've discussed in the previous slide in terms of the methodology. What we have seen is if we exclude these bottom 3, 4, 5 stocks which have very low allocation, the volatility in our portfolio increases. So it helps there, it helps. So that's the reason, actually. That's the methodology we are following, and we would like to stick to it. Yeah. Any specific questions regarding rebalance, Eesha?
Yeah, Vivek, whether we call it regarding rebalance, but there is a trend in the questions. There are lots of questions asking why we added Medanta despite the negative news from the government about it. It's the day before rebalancing. So your views on that? There are tons of questions around this topic, around healthcare stocks also.
Yeah. See, as I've told you, what you don't want us to do is something that we are not good at. We are not good at reading the news and figuring out how much impact that news is going to have on a specific stock, whether it's good news or bad news. But we don't have that capability of analyzing news and seeing how much impact it will have, right? So whether that is, okay, everyone knew it's negative, but whether that will cause stock to go down by 2%, 5%, 10%, or 20%, we really don't have that kind of capability. And we don't want to get into it because that's not our core capability. Our core capability is having the algos to figure out which stocks are best. Now, at that time, and the second point that I've again mentioned, there is a way to do it systematically, which we have tried in the past, which is when our algos parse the internet for all of these news and the social media chatter, and then use that information to uh, as one of the factors to buy or sell stocks. And what we have seen is it really does not improve our returns or reduce our risk, right? So yeah, that's what related to, I think, Vedanta, I don't have any comment, but related to the methodology, we have tried this in the past using a systematic way to include it, but we haven't been able to really make a better portfolio if we include it. Sometimes it does help that that disciplined way of investing or that systematic way of investing. Sometimes it does help also, but at other times it does not help at all, or it works against us. So net again, no benefit of having it, at least as of now, the way we work, right? Yeah. And
So,
we would really like to stick to what we are doing, obviously get better at it, but we don't want to get into human intervention. Yeah.
so Vivek, a follow-up question. Shreyash is asking, in that case, why not just avoid Medanta if you are not sure?
Why not avoid Vedanta? But why, sorry, why avoid Vedanta? Why not? Uh, See, we really don't have what we are, again, that will be a human intervention, right? That was same as human intervention. Why take a call? And as I've told you, we are not good at it. That is not our expertise, right? This has happened this time and we were unlucky. But at other times, it might be on the positive side also. And uh, we don't want to get into such a thing where we don't have a long-term advantage in human intervention. At least we as fund managers do not have any advantage. There might be others. There might be other fund managers who are able to analyze news well and accordingly adjust their portfolios, right? But if you give them data, or if you ask them that there's another way, you do quant analysis and then you select stocks, obviously you wouldn't want them to do it because that is not their expertise. Their expertise is in human discretion, right? Analyze all the statements, all the news, and then make sense out of it. And similarly, our core capability is data driven analysis, and we definitely don't want, and I don't think you would want us to get into that because we really won't do a very good job out of it, really.
Right.
Yeah.
So, like a related thing, there are people
Yeah.
asking that, if we can interfere mid-month, we can do a rebalance in the middle of the month
Mhm.
if a stock goes down by a certain percentage.
Yes. So this is, yeah, again, as I said, uh, that is same as need based rebalancing.
Hmm.
So that is something that we have tried.
Hmm.
That if a stock is going down, or there are other factors also, right? There are other factors. So any specific factor which tells us that you rebalance during mid-month or any time of the month, that is something that we have tried in the past.
Hmm.
And net, it hasn't really improved the results,
Okay.
right? The best results that we get is in month-end rebalancing, monthly rebalancing that we are currently following.
Hmm.
And again, if we are able to, we keep on researching newer ways to improve our portfolios. If at some way we are able to do that need-based rebalancing and improve our portfolios, either on the risk side or return side, we will do that. But
Hmm.
we have tried out these kind of having either stock specific stop losses or a stock which has jumped very high in maybe 10-15 days and book profits. All of these things we have tried, multiple variations of it we have tried, but really in the long run, there is it does not add to any of the either reduce risk or increase the returns. It does not do that. And that is why we are not doing it.
Okay. So can we do something in having some parameters which are tracked so that in case the situation is such that we are actually reaching those parameters, we can rebalance in the middle of the month.
Yeah, in fact, this is, I don't know whether it's your suggestion or from someone, but that is exactly we have tried. And it's not that we have given up on it. So this is something that is an ongoing process. And the ideas that I listen, obviously, if there's some new idea that we haven't tried, we go back and test it out whether that adds value to the overall methodology. So, and that is, I think, the main aim of doing this is obviously to explain you what you are doing, explain all the investors what they are doing, but also hear from them. And if there are some ideas that we haven't tried, try it out to see if that makes our methodology better, but in a very systematic way, not in a human intervention way, but in a systematic way. So I do hear all the feedback, and most of these things we have already tried, but if there's something new that we come up, we definitely go back and try it out to see if that helps us improve our overall portfolio.
Understood.
Yeah.
So Shreyansh is asking again that as per your previous webinar, you get several stock recommendations from your algo. So
Yeah.
why not select some other stock instead?
Can you repeat the question? I didn't understand.
So he's saying that as per that we get several stock recommendations from our algo. So why don't we select some other stock instead? I think we just need to explain our methodology again. Like I can try answering that question, Shreyash, that the algo gives us a list of all the stocks. Now it ranks the stocks and we pick the stocks which have the highest rank across different parameters. So in any case, we try to pick up the stocks which are the highest ranked, and that's the reason why we chose the stocks that you currently see in our portfolio. That's how the methodology works. While we do have ranks of other stocks based on the day of the rebalance, basis the results of the algo, those were the best set of stocks. Now, Vivek, Siddharth is talking about a casino math strategy, and he said it works well in the stock markets. He's explained it. Have you heard about it?
Casino math
Yeah,
methodology.
casino math. He's saying no. He's saying this is casino math. So in casinos, that's how it works. He's saying a better approach to analyze how to do stock performances. Share the number of transactions done per year, the number of gainers versus the number of losers, and average percentage of gainers and losers.
Yeah.
That's how we
I
work.
think this is what we have done. So there was a blog which Eesha was referring to at the beginning, in which we had actually analyzed our 2023 the full year's performance. I think So you should look at that. From what I remember, there were about 56 to 58 overall stocks that we had taken positions in during the year. The average loss was in single digits. The average loss of top 10 losers was in single digits. The average profit of top 10 winners was, I think, 70-80% or some very high number. So that was telling us that net we have been able to cut our losers very fast, and we have been able to ride our winners for very long. So you should definitely check that blog out. I think it will be published sometime in January, that blog.
Perfect. So, Vivek, a lot of similar questions. So, one question is what is the maximum allocation to one stock? Having 15% weightage to a stock sounds risky.
Yeah, again, see, we have about 12 stocks. So, as we have shown in the past, this is slightly a higher risk portfolio. A single stock can have higher weightage. If the things are going well, that helps us a lot, right? Last month, we were caught on the wrong foot, or rather this month, and it hurt us. But net, what we have seen is having a concentrated portfolio, and we have never recommended putting a very high allocation to gear 6. You should have a limited allocation. And what we have always recommended is if all your equity allocation, maybe you should divide between 3 to 4 3 to 4 funds, which means not to have more than 25 to 30% in Gulaq Gear 6 of all your equity allocation, right? And again, this same methodology has helped us last 1.5 months. I just want to take everyone through the returns also. There were quite a few questions about the returns,
Right.
right? And I think that will clarify some of the, and I do understand a lot of investors came in during January and February, and currently either they are kind of break even or sitting in some amount of loss. But then we have thousands of investors who have been with us for more than a year, and they are sitting very pretty on very good profits, right? So there are few questions related to returns. They joined in mid-Jan and have been making losses since then, not getting good returns since July. This is very surprising because since July, I think our portfolios would have given somewhere around 30 to 40%. So why this is though, maybe we'll try to go into this a bit. Why did Gulaq underperform? How well is Gulaq prepared for extreme volatility? How do you do when you ensure consistency of returns for all investors? There's a difference between my actual gains and reported gains. What can be possible causes? So we have done this blog. Again, it should help you out decoding small case returns. This is the blog on Gulaq website. Please go there and check out. It will help you explain some of the reasons that you might have ignored in your analysis related to returns. Yeah. So this is the performance in 2024. Initially, we had a good jump, but since last 1.5 months, it has been sideways to slightly negative. But net we have some alpha. But what I want to share is one thing is this. Again, this is a blog. We have talked about this in the past also. Risks associated with Gulaq Gear 6 is the name of the blog. And what we highlighted earlier was short-term investment horizon. If you're investing for, say, 1 month, 3 months, or even 6 months, we really don't think, and this is not really for Gulaq, but this is for equity investments in general. So even if you're investing in specific stocks or a stock-based mutual fund, I think if you have a short-term horizon, then it is risky. Portfolio concentration, if you have too much allocation to one specific fund, that is risky. Expectations of a consistent performance or expectations of huge returns, as we have seen in the past, again, that is very, very risky. And I have some data, more data to share with you. Last year, we did about, I think, 68% returns versus the benchmark was about 26% or so, right? But last year also we saw Jan Feb kind of underperformance. In June also we underperformed. So out of 12 months, 3 months they were there where we underperformed. And that is a reasonable expectation. One should have that out of any 12 months, there could be 3, 4, even 5 months where we actually underperform the benchmark. It has happened in the past, and this will again happen in the future as well, right? Again, this is very interesting. So alpha here we are seeing what is the alpha we have produced. So alpha is the difference between our fund returns and the benchmark. So over any time period, if the fund has performed, let's say 5% versus the benchmark, which has given, say, 2%. So the difference between these two, 3% is the alpha, right? And alpha negative means we have underperformed the benchmark. So here, if you take any 1 month period, the average alpha is 2.2%. But the worst case scenario, so in the worst of month, what we have underperformed is we have lost 5.3% relative to the index. So if the index actually lost 1%, in the worst case scenario, what we have seen is we lost 6.3%, right? And the chances of underperformance is 34%. So there are 66% of the months we will be in profit, but there'll be 34% of the months where we'll be in loss, right? If you look at the 3 months, which is a quarterly performance, the average extra returns that Gulaq Gear 6 has generated is 6.9%, right? But the worst case is 13.7, which means that over the worst performing quarter relative to index, गुल्लक गियर 6 ने 13.7% एक्स्ट्रा अंडरपरफॉर्म किया या लॉस किया, whichever way you want to see it, right? But the chances of underperformance reduces from 34% to 20%, which means out of every 5 quarters, 1 quarter will still be in loss. But if you see 1 year, if you hold Gulaq, at least what it has been, the performance been over the last few years, the live performance, if you hold Gulaq, the average outperformance it has given is 30%. The worst case alpha in this case is 0.3%. So over 1 year period, we have never underperformed the benchmark. So the chance of underperformance is 0%. Again, this is as per the live track record that we have generated. We are not implying that we'll never underperform the market on a 1 year. We cannot give that kind of commitment to you. That is not possible. There might be a case we underperform even during a 1 year period, but at least over the last 3-4 years that we have been live, this has never happened. Yeah. Again, returns, related to returns, there are certain costs that we all ignore. Brokerage cost is one. There's STT, there are DP charges, there are slippage costs, as I explained some time back, and also rebalance time. So if you are not rebalancing in the first 2-3 days, then obviously the returns that you see on small case platform versus returns that you get would be different, right? There was one question related to that somebody has invested mid of last month and he hasn't really seen too good returns. There's a decent gap between his returns and what is being reported on small case. So I'm not sure. I think I would encourage him to connect to our customer care directly so that we look at his statement and analyze. But one of the causes could be, and I've seen this with a few other investors that I've spoken to, is that they've been investing over, let's say, last 6 months or so. And this is a hypothetical scenario, somebody investing not one time but have been investing either through SIPs or additionally investing. So I've taken a case where these are the monthly returns over past 6 months, again hypothetical returns, right? So the NAV would be this from 100, it will be 113.6 at the end of 6th month, right? And this particular investor is investing 20,000 every month for the last 6 months, right? So what is the fund would show that it has returned 13.6 in last 6 months as per this. This is what you will get to see on small case, right? But what is going to happen is when you see your own returns, the fund returns are 13.6. Your total investment is 1.2 lakhs and the current portfolio value is 1.29 lakhs. So overall returns is 8%. So there is, you might be surprised that I've been investing for last 6 months and the fund it is showing returns of 13.6, whereas I just got 8 or slightly lower than 8 because of brokerages and slippages. But there is this difference. And this difference is, again, it could be, I'm just pointing it out because I've seen quite a few investors come to us with this problem. And this is not really a problem. This is actually the way they are looking at returns as slightly incorrect, because if you are doing SIP or investing in between, then that won't really be the right way to look at the overall returns that the fund has generated. So I'm not saying this is the case with this specific investor, so he should definitely get in touch with us. But yeah, this is a common problem that I have seen. Yeah. So yeah, I think that's about returns. Any other question, Eesha, that we see related to returns?
Yeah, Vivek, just a second. I would also like to add, the returns that I am an investor in Gulaq, and I also saw quite different returns in my actual portfolio than what was mentioned. So the 1 year return as per what is displayed is also 95%, whereas I got only around 70% return in my portfolio. And I know the reason, because there were 2 months, 1 month I rebalanced only on the 15th, and there were two other months where I rebalanced only on the 5th day. So, plus I also added some funds during the year. So there were 4 different, like every quarter I added more funds. So of course my annual return would be different from what is shown in the what we are reporting, because those returns are actually for somebody who has followed what we said and who invested at the right time, did not change the allocation of the portfolio, and did not add anything in between.
See, one of the reason again is I saw day before yesterday one investor who has invested 50,000, right? So for him, I think his brokerage plus STT plus the DP charges, which are for every stock that you are selling, your brokers charge some fixed amount, either that is between 10 to 20 rupees, but that is still a cost. So when
Right.
he calculated, because it is a 50,000 rupee account, and because there are certain fixed charges which on a smaller fund could be substantial. So his calculation was these costs would add up to about 5 to 6% annualized for him. But then again, if he has invested somewhere between 2 to 3 lakhs, this leakage would be maybe about just 2% or so. So as what we have been recommending time and again, it's okay to start with lower amounts, but Gulaq portfolios would only make sense if you have scaled your overall investments to about 2.5 lakhs, because our fees is also 5,800 for the year. So yeah, so try to increase your portfolio size to about that, and then you'll see that overall uh, these fixed costs would be much lower percentage of your overall portfolio, and it will start making sense then.
Right. So Vivek, certain questions where people are asking if we can share the returns after long-term and short-term capital gain taxes. And there's another question where they're asking if we publish XIRR factoring in the brokerage and associated costs.
So brokerages, yeah, we don't do that because everyone is on a different broker. And even with the same broker, they might have different brokerage plans.
Yeah, yeah.
But I would recommend everyone to get in touch with their broker to see because there is decent amount of transactions that are happening month on month, and if that brokerage could be reduced.
Right. I think there are a lot of zero brokers like Zerodha, Angel, 5paisa, Upstocks, but even the traditional brokers do give preferential rates if you are trading considerably and if you're actively trading in the markets. So traditional brokers charge more because they give you an RM and they give you additional advisory services. So if you have an RM, please contact them and ask them if you can get reduced prices, because the churn, as you know, is high.
Yeah, and I think everyone should be aware about these few extra costs that either brokers or small cases charging. It could be related to the rebalance or SIP or invest more. Certain brokers or small case, they charge something extra, which is nominal, but it can add up. So you should definitely check that out.
Right, right. So I think Siddharth is giving advice to everyone to also use the breakdown view feature in small case. So there is a cost calculator or something of that sort, a tool that's available on the website where you can see what are the associated costs, whether it's the taxes, costs associated to your brokerage account, DP charges, etc. All of those are visible for your specific portfolio in which you have invested for your amount. So you will get more
And the
idea.
brokerage also, you can
Yeah.
actually edit the brokerage as per what you are getting through your broker. You can edit that and use what the brokerage that you are paying to see. So that's a good idea, and that is somewhat we have used in our blog also, the returns using that specific calculator. So that's a good idea. Yeah.
Right. There is another question. Okay, someone's asking why is my question not asked from the Google form? So we have not completed all the questions yet. We are still going through. We do have more questions. We have tried to summarize all the questions into segments. But please know that there were 200 plus questions that we received. So if that too in just 2 days. So it's not feasible for us to ask each and every question. In case you see that we have missed your question, please ask that again, and I will try my best to take it up.
So nothing against you.
Yeah, nothing against you, don't worry. It's just too many questions coming our way. Yeah. Yeah, Vivek. I think we can continue with the rest of
Okay.
the questions. Yeah.
So we have covered returns. Okay, some more questions related to investment guidance. What is the ideal amount investment to cover all costs? Again, the higher it is, the better, because most of these costs are fixed cost. But the bare minimum, because you're paying fees of close to 5,800 per year and some more costs to your broker, to small case. So I think it will start making sense when you have about 2 to 3 lakh in that range. And again, the higher it is, the better value you will get for the kind of fees that you are paying. But about 2 to 3 lakhs is the ideal amount. There's no maximum as such, but if you have, and we have quite a few investors who have invested more than 50 lakhs, and many of them are now getting in touch like, uh, regarding our PMS, because in PMS we are doing the execution and we have our own execution algorithms, which helps you drastically reduce your slippages, at least at the higher investment amounts. But there's no maximum as such from our side. But again, maximum in terms of percentage allocation of your overall equity portfolio, you should maybe not have more than 25 to 30% to Gulaq. Is it recommended to do a SIP? If yes, at what frequency? Again, whenever you have money, and whenever you want to have that kind of money which you won't need for the next few years. So anything that you can actually invest in equity markets. But overall, as Eesha mentioned earlier, do take into account your risk profile and accordingly what your asset allocation is, and invest as according to that. So do take that into account while determining how much you should invest in Gulaq, or for that matter in equity funds, right? But again, related to SIP, I think monthly is just fine. Really, some people have asked whether they should break it down to weekly or quarterly. I think the biggest uh, the biggest thing that will impact your returns or the overall portfolio is how much you are putting in your investments and for how long. These are the two big factors that are in your control, right? Not the frequency. If you really want to break it down into weekly, you can do that. It's not really going to make any impact at all. Those are the two biggest things that you should worry about, that how much you are saving and investing and for how long you are able to do that. How to maintain consistent returns given when adding funds to existing portfolio, small case assigns investments in a subset of portfolio, potentially disrupting stock weightages. So yeah, so this is a question again. I want to explain this question. So somebody had invested, say, about 1 lakh with us, and his portfolio would be in exact percentage allocation to those specific stocks. But if you put in, say, additional 10,000 or 20,000, uh, small case methodology won't actually let you buy all the stocks. It will just maybe have you buy 4, 5, or 6 stocks. So for that period of time, until you have rebalanced the next month, on this 10,000 of your portfolio, it won't be exactly same. Like, but again, the average portfolio with us is about 2.5 lakhs. And I think the average SIP would be about 10,000 or so. So it is about maybe less than 5% of your overall portfolio, which really won't be the exact portfolio that we have recommended, right? So again, it really won't impact your returns so much. Sometimes it might help you, sometimes it might hurt you. But net, I think overall, it really won't impact your portfolio by large. There'll be some slight deviation to model portfolio. But again, that deviation most likely is random in nature. And that is why some months it's going to benefit you, some months it's going to hurt you. But yeah, no significant impact it will have on your portfolio. So again, don't worry about this thing that a small part of your portfolio is not as per what we are recommending. What is important is you are putting in that money month on month. Again, not only with Gulaq, but with any other fund as well. Market timing, is it advisable to make fresh investments in bull market? Again, definitely advisable if you are investing for the long run. Do not try to time this market. And this is one of my favorite blogs, Discipline versus Luck in Markets. You should go and check it out on Gulaq. This tells us that really discipline is what is in our control, what we can control, and that is the biggest factor in our overall portfolio. Gulaq future plan. When is the low churn portfolio coming out? Again, we are working on it. We have been working on it, and I know I indicated about this sometime in December, I guess. So it's been 2-3 months, but uh, the results that we have seen are encouraging, and we might be able to do in the next release it in the next few months. But again, I don't really have a date right now. It's still work in the progress, but we are making very good progress on it. Do you have plans to offer this service in mutual funds? Yes, we definitely do have plans. Uh, but to get a mutual fund license, it takes about a year or so, and it's a really big project in itself. We are discussing, and we definitely at some point of time would like to offer this specific strategy in mutual fund. Definitely, we would want to do that, but it's a slightly longer term project.
Okay, okay, Vivek, there are quite a few questions in the chat box, so maybe we can pause here and take those.
Yeah.
Uh, so firstly, I would like to inform everyone that if you have an operational question, if you have faced any operational issue, we have noted your point. We have shared it with our customer care executive, and they will get in touch with you shortly in the coming week to get your issues resolved. So I see, Khizar, I see your question. I think this is a issue that you're facing. You've mentioned that in the last few months you've made positions in cash. Now you're asking what to do, because if you wait for us to reinvest in upcoming months, or you because you think your cash position is affecting the CAGR return. But we never really, invest. We never move into cash. We are always invested in the equity markets. So this seems to be a technical glitch in the way the rebalance is happening for your specific case. And this again will be given to our customer care executive, who will get in touch with you and with small case to resolve this issue for you, because this should not be happening. Now, Vivek, Brijmohan is asking, to do SIP, I should know whether you have purchased for long term or short term. So, what is our view there?
No, I don't understand why that is needed. What we all know is almost all the returns, or rather, actually all the returns that we get, all the profit that we get, it comes under the short-term capital gains category.
Right.
That is what we know for sure,
Mm-hmm.
right? But the investments could be for long term, in the sense that you keep investing with us, and they've been investors since the beginning. You keep investing with us for next 5 years, 10 years. So you're actually be getting that advantage of compounding. Obviously, there'll be some small part of taxes that you'll need to pay every year, but at least what the history has shown, that even after paying those taxes, we are able to generate significant alpha over the benchmark indices, right?
Right.
So I really do not understand why
Yeah.
that piece of information is necessary. But if it is necessary, I think you should account for all the gains in the short-term capital gains category.
Right. And I think I would just like to add that even in case of mutual funds, people who are investing, we say that, it's for the long term when we invest in mutual funds. But at the back end, mutual funds are constantly churning. In fact, we don't even get to know whether a mutual fund is churning on a daily, quarterly, monthly, or on need basis. So they have, in the case of small case kind of a product where we are an investment advisor, we have to take the investors' approval before making any changes in their portfolio. And that is why this setup where you are rebalancing your own portfolios. We are just giving you the advice. So in this case, you get to know when we are churning. But that being said, our investment is always for the long term, and we suggest that clients stay with us for the long term, for 3 to 5 years, because the returns will start making sense, much more sense in that period. We have seen that in 1 year also, Vivek has shown that the probability of loss has been zero. And we've been around since more than 3 years now, almost completing 4 years in May. So we see that in 1 year period, which is still shorter term, it's probably a medium term, but in 1 year also the returns have been positive. So you should definitely evaluate the performance for a longer duration to really start making sense of the returns and of that strategy. That's just my 2 cents on this topic. Moving on, many other questions. Siddharth is asking if it's compulsory for all Gulaq employees to invest only in Gulaq product. Why not test out other fee products and see what they are doing so that we could get tips on building our strategy? So Vivek, what do you have to say on that?
Yeah, I think we should make it compulsory. But anyways, all the Gulaq, at least the Gulaq team has everyone, I know everyone has invested in Gulaq portfolios. And our company ST also, I think most of the employees have invested.
On
Uh,
voluntary basis. This is not at all compulsory. So we are free to, he's suggesting that why not we try out other portfolios and take tips from there, study their strategy to figure out if we can incorporate something from there.
I think we are always trying to learn and find out new ways of improving our portfolio, but not necessarily by tracking what portfolio others are constructing. But we definitely are. See, I think the thing that we are doing is we are keeping track of all the latest research that is going on in factor investing space. We like to read that a lot and try to see what all we can do, uh, the new things that we can do to make our portfolios better. So we are always doing that, but not really tracking anyone or their portfolios.
Got it. Okay, I think Akshat is asking that he's noticed quite a big slippage in the last two rebalances. Stocks being sold go down heavily and stocks being bought shoot up on the
Yes.
rebalance day, leading to reduced returns.
Yeah. So see, this is what I explained. This is not really slippage, right? Because what happens after you have exited or added a stock is not really a slippage. It might be you can call it bad decision or bad call that we have given based on the returns that you have gotten last 1-2 months, but it's not really a slippage, right? And what we have seen is we have underperformed in last 1.5 months, and that is pretty normal, I think. If you're having a bigger account, yes, as I said, try to rebalance during the more liquid hours, which is towards the beginning or towards the end of the day.
Right.
But that specific thing is not really slippage.
Right. In fact, Vivek, Akshat is saying that, stocks we sold went down heavily after rebalance and stocks bought went up. So that's actually a good thing for us if you act.
Yeah, I think he meant the
other way
other thing that the stocks we sold went up and the stocks we bought came down. That's what happened. I know that's what happened, but I think that's what he meant.
Okay.
That's really a good thing. What if that is happening to him?
Yeah, that's
The stocks
actually a good thing. And maybe because my interpretation of the question was that it could be because of high volumes. Many investors who are following our advice, leading to that massive movement. So if you're buying something, the price shot up because there are lots of investors who are running after.
Yeah, but we have seen that, Eesha, we do take into account what's our overall investor size, asset base, and also the liquidity in these stocks. We do take that into account. We analyze that, and currently, as of now, we don't see that it could impact. It could impact the prices in a way that is happening. So that is mostly random, and more so because what we also see is investors don't rebalance at the same time. Like throughout the day they are rebalancing, and also over multiple days they are rebalancing. If all of this they are rebalancing at one time, maybe it can happen, but definitely not in the current structure. And we are quite far away from that kind of AUM where it starts impacting these slippages. So yeah.
Okay, perfect. So, Rishi is asking if there is a risk of front running by the manager or team members of a small case portfolio, given that there is no regulatory oversight like SEBI provides for mutual fund houses. What
No,
is
we do internally have checks and balances in place. All the employees have to submit their DMAT transaction statements. All of that is happening definitely. So, and we are very professional company. So I don't think there is any chance of front running. But yes, there might be other big investors who might do that. I've heard that happening with much bigger, small, or more popular small cases. But definitely, I don't think that is a possibility within ST. I don't see that happening. Yeah.
Okay. And there is a lot of, regulations that SEBI imposes on us. So there are audits, there are checks. That's the reason why we also collect this data internally of.
Yeah. And see, another reason why this is not possible is because when I told you that all the rebalancing algorithm that is being run, that happens at the end of the day when the markets have uh, stopped, right, after 3:30. And when the new portfolio comes out, we actually upload it before the next day on small case. Right. So even though I might know in the evening that these are the stocks being sold, or these are or for that matter, any other employee might know that these are the recommendations, they'll actually be able to trade only when the market opens next day. And at that point of time, all the investors, small case our Gulaq investors, would have that information. So it's not really, I don't think that is a possibility, the way we are rebalancing our portfolios, which is after the market closes.
Makes sense. Okay, thanks, Vivek. So Aditya is asking that does Gulaq calculate returns based on calculations done in small case or FIFO? I think CAGR returns shown in small case are actually misleading because CAGR returns we get from brokers platforms are real.
I really didn't understand this question because I think the methodology of FIFO or LIFO would only come in terms of calculating uh, the whether those returns or profits are either long term or short term. That's where it will actually impact whether it's LIFO or FIFO. But otherwise, in calculating the actual returns, that is not really going to have any impact on what we are considering.
Yeah, that makes sense.
Yeah.
That makes sense. Okay. Jagdish, is it a good idea to add to the investment when the returns are down for the last 2 months? Or should I wait to add it when the returns start improving? Similar question of what you've already answered.
Yeah, again, see the way to think about it is, let's say you are tossing a coin, right? So if the last three or last five tosses have been heads, would you expect a tail next time? Obviously, I think we all start expecting a tail next time if the last five have been heads. But what we also know for sure is on any toss, the probability of getting a tail is just 50%, irrespective of what has happened in the past. Right. So I think the same way to think about the investments also, if the returns have been lower or higher, it really does not say too much about our future returns. So I think that's how one should think about while investing.
Right. Okay, Kalpesh, you're asking the question on Medanta, which has already been answered previously. So please rewind the video. You will find our response. This YouTube live will be available on YouTube as a recording. So you can refer to our response. Now, Rohit is asking what should be our approach if we opt for SIP and have some stocks which later completely removed by Gulaq during the next rebalance. I mean, I don't know, Rohit, why you would to. So once you've invested in, you've done a SIP with us, at the end of the month, when you get a rebalance update, small case would automatically account for your additional investment of SIP in the previous month. And your new rebalance update will consider your total investment, the initial plus SIP amount, and it will rebalance that entire amount basis the new portfolio that Gulaq has given out. So I don't see any manual intervention needed by you or any strategy that you need to do. The platform is doing it for you.
Eesha, can we take on few more questions that we got, and after that we can continue the new
Sure.
questions that we're getting? So
Sure.
there were questions around the PMS also, the performance and fees. Also, can PMS fee be deducted and how many stocks? So these are the returns that we have generated. Again, this is last 4.5 years of performance, and the gross returns we have generated is almost 36% versus about 18% for BSC. Again, if you see in this, the standard deviation and max drawdown, which is the measure of risk, and this maximum drawdown happened during the COVID time when BSC fell 30%, our portfolio fell about 18%. So in terms of risks, I think we are taking lower risk than the BSC 500 index. And in terms of returns, we are able to generate almost double the returns in the past 4 years or so. This is the risk returns. Now we have about 80 stocks in this PMS portfolio. Maximum or minimum weightages, again, these are not defined. These are defined in the sectoral, but not stock specific weightages. And can PMS fees be deducted from capital gains tax? No, it cannot be deducted. This is the fee structure for long alpha PMS. Again, same methodology as in Gulaq Gear 6, only a more diversified portfolio. And here the standard fixed fees is 2.4%, but for this month, up until this month, we are giving 60% discounts on these fees. So the fee for this would be 0.96% per annum for life. And there's no entry or exit load in this PMS. Obviously, there are other options like only performance-based fees, or also a mix of fixed fees and performance-based fees, which is the option 3, right? Yeah, I think those are all the questions that we got, and we can take more questions, whatever we are getting.
Sure, Vivek. Yeah. So, Ritesh is asking, what is the maximum drawdown we have seen in Gulaq Gear 6? I think we have some slides which can showcase that.
Yeah, let me see. Yeah, can you see my screen?
Yeah, Vivek, we can see.
Yeah. So this is the maximum drawdown that we have seen. Can you see my screen? Yeah.
Yeah, now I can see it, Vivek.
Okay. This is the maximum drawdown that we have seen in the live track record, where Gulaq Gear 6 lost about 20%, whereas the max drawdown in the index was about 18%. So ballpark similar to what index did. But as you can see, we are able to recover our losses faster. How you can tell that is, this is the zero line, so it's not showing the returns. It's only showing the time when we were in drawdown, right? And this blue line, whenever it is reaching zero, that means we have recovered our loss and are in positive territory, right? So from this 361 first day to about 600 day, during this period, the BSC 500 was in a loss, but we actually kept on recovering and making higher highs during this point of time. But our ballpark, the overall drawdowns are in similar category as that of BSC 500. So yeah, that is the past. This is as per the back tests. And the earlier slide was the live results. So as per back tests, we can see during these 3 big drawdowns, One is again COVID 2020, market lost 30%, whereas we lost maybe about 26-27%. In 2016, we had similar drawdowns of 20%, whereas in this 2013, market lost about 13%. We lost less than 10%. There have
Hmm.
been cases where we lost more also. So this specific 2017, where market lost 7% and we lost about 12-13%. So there have been few cases where we lost more, and but these big losses, I think we have done pretty fine. So overall, you can see this is the drawdown, and it's pretty much in line with what BSE 500 has been doing when it loses. Yeah, yeah. I think
Uh,
that's
oh, all right. Thanks, Vivek. So Abhishek is asking last time, uh, we asked him to email us for any to evaluate the portfolio, and he mailed but didn't get any reply. So Abhishek, if you can drop your email address in the chat box, I will check if in case your shouldn't have happened, but if you can just share your email ID again so that we can check, and would request you to also send another email ID, sorry, another email so that I can personally,
we'll check this. Yeah, we'll check
yeah, we will
this.
get this checked. Um, we have lots of other questions. Okay, let me see. Santosh is asking, how often do you rebalance the long alpha PMS?
Again, same methodology, monthly rebalance at the start of month. Exactly same methodology. It's just it's more diversified in nature. Otherwise, everything is same.
Okay, Siddharth is asking, what's your opinion for the optimal SIP amount, minimum amount versus less than minimum amount to maximize the benefits? I think he's talking about our minimum investment amount, which is 24,000 or less than that to maximize benefits. So what should be the ideal SIP amount as per you?
I think to maximize returns, he's asking.
To maximize benefits. So yeah, maximize returns or, the right.
Invest as much as you can, but don't go overboard. I've
Uh,
seen a lot of people suggesting, and people, the fire is a trending topic these days. A lot of people are going in for fire and they try to save as much as possible.
hmm,
I don't think that is one extreme, right? Another extreme is somebody who is not investing at all. I always feel a balanced approach is a much better approach. So obviously spend what you want to spend on, but at the same time think about your future financial goals and what you should be saving, and keep a balanced approach. I think that is, yeah, that is what I'll recommend.
Okay.
Ultimately, at the end of the day, returns really won't matter whether you invest 10,000 or 1 lakh. It will do, the markets or the fund will do what it will do. It's not dependent on how much one is investing. Yeah, but
Okay.
try to save if you have, let's say, if you are pretty young and don't have any uh, financial obligations in the near future, the big ones,
Mm-hmm.
uh, try to save a good part into equities. Yeah, that's what I would recommend.
Okay. So I think Vivek, he's also, referring to the question that we were discussing in the morning today, that if because our minimum investment amount is 24,000, and if I'm
Yeah.
doing an SIP and I'm adding only 5,000, is that better, or with every additional amount investment should be equal to 24,000 only?
No, it's definitely not required that every additional investment should be 24,000.
Hmm.
That is the minimum we need to get started. But after that, your SIP could be higher than that or even lower than that.
Hmm. Hmm.
That is just the one-time investment that we need to get started.
Okay.
So if you think you want to save or want to invest just 5,000 in Gulaq, I think that is fine. Yeah.
Okay. And the returns, like we were discussing in the morning, that will the returns, like, should people, if someone has 24,000, should they invest 24,000 instead of less, or let's say wait for a couple of months to accumulate 24,000 and then put in that money
I
so that,
don't think we should wait. Yeah. See,
okay.
I don't think we should wait because just because there is going to be some model error. So
Hmm.
your portfolio is not going to be exactly the same that we are recommending.
Hmm.
Because even though it is different, you're still invested in equities, and over short term or long term, your expectation from equities on the upside only that it will go up. right? So even if there is that model error and you are unable to invest 25,000 or larger amounts, even though investing smaller, you should go ahead and invest. That is important, yeah. Because I think overall, as I was telling you, few months, that model error would be random. The impact that will have on your portfolio is random. So sometimes that smaller part of the portfolio, which is not as per uh, the model, sometimes that might do well, better than the model, or sometimes it might do worse than the model. But net, you're sitting on long equities, which are as per the methodology we have selected. Those are good stocks to have in your portfolio. So even though you might not have all the 12 or 15 stocks, you still have some stocks long. You bought those stocks. So overall, the expectations is you'll make some money.
Perfect. Okay. So Siddharth is saying thanks for the answer. Much appreciated. We have Amol. He's saying, do you recommend to put some stop loss like 10 to 20%?
Again, see, we have tried that. We haven't been able to make it work. Because what happens is, whatever that stop loss is, whether that is 10, 20%, if you put that stop loss and if the stock keeps going down, so we will be able to avoid those losses. It will turn out to be a good decision. But on the other side, and what happens majorly is we see that drawdown, but then after that 10% stock starts recovering and it keeps going up, then that will turn out to be a bad decision. And what we have seen is net, it is more of a bad decision. In more number of instances, it will turn out to be a bad decision than a good one. And that is why having a stop loss actually has uh, reduced the overall portfolio performance when we tested it out. But yeah, as I said, we keep trying out multiple variations of it. But up until now, it looks like that this is not a good strategy to have.
Yeah, and you know, I would urge everyone, all our investors, to not take actions by themselves, because if you start uh, putting a stop loss and exiting from any stock from your demat account directly, to sync it with the small case app would be a challenge, because you'll have to write to them. Also, it's not advisable because we have created the portfolio looking at the risk and return of the entire portfolio. So if you tweak our suggestions, your returns and risk could be very different. So that's the advice, to stick with what we are doing. If you want to do day trading or swing trading, play with some amount of capital that you've designated for yourself separately, but do not tweak with the advice given by us, or for that matter any other investment advisor. Okay, then someone's saying, in last rebalance, one stock was bought which was sold in the next rebalance. Kindly give time to perform. He's asking us to comment on this.
Yeah, again, I think this is related to the churn. What this does is it increases the churn, and that is what we are testing out now, that how to reduce this churn. If we are selecting a stock, we should be maybe more sure that we'll be able to hold it for longer. Or if we are exiting, it might happen the other side also, we exit and next month we again have it in buy recommendation. So this is something related to that, to reduce the churn. And that is something, as I told you, we are currently working on. We have seen good progress in that side. And maybe in the near future, we'll see that some change in the methodology so that we have lower churn. So, yeah,
Right.
we are working on it.
Yeah, I think we would like to test that strategy before really launching it, and that's why we are taking that much of time. We would want to thoroughly test it internally before really launching it. So Kalol is asking, how do I change Gear 6 subscription from one broker to another broker? This is usually, Kalol, not possible, but you can try to write to small case and our support team. It's an operational question. They'll be able to help you with it. You can write to both support@gulaq.com and to the small case support ID, and they will be able to guide you on the steps to do so. Parmesh is asking, I think this is linked to what we were just mentioning. Shouldn't we book profits earlier than rebalance date if stocks are going up? He's saying IOCL and Cient went really up, but we didn't sell on the risen prices.
Yes, in this instance, I agree. But there have been other instances last year when the stock has been going up, and if you would have booked profits, there's no way you would have achieved. I think last year was about 68%. So
Hmm.
there's no way one would have achieved that performance last year. So again, net in few of the cases it will work out, but as just as you mentioned, Isha, I think you should not try to play around with these recommendations, because last year there's no way you would have made that kind of money had you kept on booking your profits the way you are suggesting right now, right?
Makes sense. Okay, Ashish is saying in PMS 80 stocks are there, but in Gulaq only 17. So why is there that big of a difference? And there's another question. He's saying, why do you have 70 to 80 stocks? Isn't that too high for a PMS portfolio?
Uh, yes, that is maybe too high if you consider the way most of the PMS have been performing.
Hmm.
They try to really shrink the portfolio, make it very concentrated portfolio in order to generate returns. But again, like last year, we generated about 60% returns in PMS, and we have been able to do it with 80 stocks, right? Obviously, had we had a much smaller portfolio, we would have generated 70%. But still, it's a very, very good performance considering we had those 80 stocks, and we have mostly had a much larger portfolio all throughout these 4 or 5 years, but we have been able to generate returns,
Hmm.
right? So yeah, we don't agree to that in order to produce returns, you have to shrink your portfolio. And again, it also depends on how you are allocating weights to these 80 stocks. I think this month, the top 20 stocks have about, from what I remember, 65 to 70% of the weightage is given to these 20 stocks, and the rest 30% to the rest 60 stocks. So it
Hmm.
also depends on how you are allocating weights to these stocks. But yeah, I think it's working pretty well. There's been a lot of demand from the investors that we roll out a Gulaq PMS, which has just about 12 to 15 stocks. We are currently seeing if that is the way we want to go ahead and launch that kind of PMS. But
Right.
again, I think even with 80 stocks, we have been able to beat the index uh, convincingly. So that is not the right. That's kind of a myth that you need to really have a concentrated portfolio to beat
Hmm.
the index.
Right. So Khizar is saying that year six is the best. Why do you want to bring a new small case? I
We
subscribe to
will
the
never,
small.
yeah. See, the idea is not to bring new small case,
Hmm.
because if we are bringing in new small case, we just want to offer the best strategy we have to everyone. So, but we definitely want to improve Gear 6 wherever we can. So
Hmm.
that's the idea. The idea is really not to bring in a new small case and get more of your money. So that's not the idea. The idea is to provide you with the best portfolio.
Yeah, yeah, that makes sense. So there's another question by Sudhanshu. He's saying all the stocks are bought at very high prices in the new rebalance. Don't you think year six is getting expansive, makes it vulnerable for a fall?
I really don't know how to answer this, because if it's due for a fall, I don't know. Again, it depends more on the market. And what we have seen in the past, as we were explaining, there have been months, there have been quarters where we have underperformed, right?
Hmm.
So I don't think we should. Our aim is definitely not to avoid picking in wrong stocks. There is no way to do that.
Hmm.
What we want to achieve is, if we have picked whatever stocks we have picked, if it is working out in our favor, we try to hold as much as possible. If it is not working in favor, we have to get rid of it as soon as possible. So that risk management is important when we have those stocks in our portfolio. Again, it is getting expensive, I know, but that's why you see the shift also. We are shifting our allocation to large cap. That has been happening over the last 2, 3 months. right? Those are all the things that the portfolio is, or the algorithm is adjusting the portfolio.
Hmm.
Yeah, that's what is happening currently.
Hmm. Hmm. Yeah, so Krishan Kumar is saying stocks are bound to go up and down. That's their nature, which is very true. I think the same way, people can say that the Nifty is going up so much. So is it due for a fall? So
Yeah.
nobody can really say that till the time the algo is suggesting that this is the portfolio that it is throwing out, we are investing.
I think these lot of decisions would become very easy if you
Hmm.
have a longer term view. So if you are
Yeah.
able to look 5 years down the line or 10 years down the line, these
Hmm.
all decisions will be very easy. In that case, also, if the markets fall, because this time in COVID, markets fell and recovered in no time. But even last time in 2008, when the markets fell, I think they recovered within 2 years. So for 2 years, for some, it might be very long period of time. But if your investing
Hmm.
horizon is say 10 years, then 2 years, if the market is falling during those 2 years, you will actually like that fall because you would want to invest as much as possible in that fall. So I think a lot of decisions will become easy and we'll be able to handle markets better if we have that long-term horizon.
Hmm. Makes sense. So couple of more questions, Vivek, before we close. Sharad is saying our stocks in year 654 the same. So yeah, that's true.
Yes.
They are all the same. The equity composition of each of these portfolios is the same, but the debt allocation would have uh, different weightages and different ETFs. So think Uday, does Gear 6 aim to share some part of profit month on month or capital appreciation?
Sorry, Isha,
So I
can you
think
please
he's asking
repeat?
if there is any. Yeah, so Uday is asking if Gear 6 shares some part of profit month on month or capital appreciation. I think how it works is straightforward. So to answer your question, Uday, whatever amount that you have, once the rebalance happens, whatever amount you've made will get rebalanced. So whatever, if let's say your 100 rupees portfolio went up to 120 and we ask you to churn 60 out of that, you will sell stocks worth 60 and you will buy stocks worth 60. So whatever capital has been appreciated will be part of the overall portfolio. If you want to withdraw, you may do so, and the withdrawal will also be based on our weightages. So that also the small platform will take care of. Secondly, there are dividends which would be coming. So dividends come on a regular basis for some of our stocks, and those will directly be credited to your bank account. So that part of the returns is something that goes directly to you. So I think Vivek, some words of appreciation also. Khizar says usually people, do the session for 60 to 90 minutes, but we have done it for over 100 minutes. So thank you so much. That's
No,
really
I
kind
think
of you.
we really enjoy interacting. Uh, I do. I know Isha enjoy these sessions. So yeah, we love interacting
Yeah,
with
yeah, that's
investors.
with our clients and hearing their views, because that's how we will be able to improve and cater to your concerns. Even Pramesh says Vivek is really knowledgeable about the product and Isha is a great host. Thank you so much, Pramesh. Okay, he's saying last episode I was not there, so yeah, I'm back. Thank you so much for noticing and for being. I hope you are also our valuable investor. We are happy to be serving all of you and trying our best to provide the best kind of portfolios that we can. Vivek, should we take a couple more questions before winding off?
Yes, we can take. Yeah.
Okay, perfect. Um, okay, so Sharat says it is always necessary to wait for month end to post rebalancing update. So, yeah, Sharad, that's a decision we have taken. We have decided to do a monthly rebalance and we just had to pick up one time during the month. So, based on the analysis, we figured that the end of the month is the best time to rebalance the portfolio. So, just so that all the investors are on the same page and they know that this is the date, we have picked up the last day of the month. No other reason really. Okay. Okay, so Saif is saying that he is going to discontinue being our investor. he disagrees with our strategy. I think that's a comment that we have got. Vivek, anything you want to add to that?
No,
Anything you want to say?
I think if you really are not comfortable, then definitely you should not invest. That's what I'd like to say. If you have to be really comfortable in, it's your hard-earned money, and you have to be comfortable in the strategy that your fund manager is suggesting. And if you're not comfortable, yeah, you shouldn't. It's okay. We are trying to educate people so that they become comfortable. But
Hmm.
if you're not, then I agree with you. You should not invest in that case. Certainly, I would not invest where I am not comfortable. So I think that's the right decision.
Hmm. Fair point. Fair point. So Dhanshu says I have 50% of my portfolio in year six. Please suggest other low vol investments to control my heartbeat in case of a fall.
Yeah, I think he should definitely bring it down. So 50% is really high. And that's what we suggest. Maybe
Yeah.
have 25 to
The remaining
30% of your overall portfolio. So 50% is high.
hmm,
Yes. And I don't know since
hmm,
when you have been
in any
investing in
one product.
equity markets, but last 3, 4 years have been really good. And if you had been investing during the COVID times, you know what equity markets are possible. Uh, they can really fall down very, very sharply. Obviously, in the long run, they go up, but during those times, it's really hard to control your heartbeats. Yeah, I think you should bring it down.
Right. So
Allocation to Gulaq Gear 6.
yeah, so he's asking Vivek for your suggestion on any other low vol product that you could suggest. I think 50% he's done in Gulak and rest 50 he wants to put in somewhere else. But I think we've always told people to have, if you're looking at equity, it should be in three separate products, not in one. So do you have
And
any
I think
suggestions,
mutual
Vivek,
funds,
on
their mutual
other
funds also
products,
they're
the other
pretty
strategies?
good mutual funds. But the way to select is
Hmm.
obviously uh, have a look at the returns and the kind of fees they are charging. But it should not be thematic portfolios like small cap, mid caps, or sectoral portfolios. Uh, what I personally like is flexi cap portfolios, which invest or which gives the manager flexibility to allocate capital to where he sees the opportunities. So select any good flexi cap fund, but I think he has already invested a lot in equities. So maybe he should select either the debt funds
Hmm.
or have some allocation to balanced funds, depending on your risk profile.
Yeah.
So that's the decision you should
Hmm.
take, definitely.
Yeah, even I think the index funds, Vivek, because I personally am an investor in index funds, and
Yeah,
while they are equity, they are still the lower side in terms of risk.
yeah. Index funds
Okay,
are great. Yeah,
so
I agree.
perfect. So I think the last question we can take is around gold. Someone is asking that, they have 40% of their portfolio in Gulaq, and what do they think about keeping gold as a hedge?
So gold has given very good returns over last few years, and we are seeing a lot of investments going into SGBs. So I think one thing is
Hmm.
definitely clear that if you really want to give some allocation to gold, SGBs are the best way you can take exposure towards gold. But what we have also seen is in over long term, I think gold is as volatile as equity markets. So the kind of risk that you're taking is kind of similar to equity markets, but in terms of returns, it really does not compare well to equity markets. So yeah, that's what our view is, that you'll be taking kind of
Hmm.
similar risk, but not really, you won't be getting that kind of returns. Obviously, I think last few years, gold has given very good returns because of the high inflation and because of the COVID, all that we have seen. Gold in times of crisis is really good. But I think if you have a proper debt and equity are pretty much what one needs in order to make a good balanced portfolio. If you want, you can have some allocation to gold, but over long run, in terms of returns, I think, yeah, I don't recommend gold really.
Perfect, perfect. So I think there are lots of thank you messages as well. So thanks a lot, Vivek, and thanks everybody for joining us. We will see you soon next time in the next webinar. Thanks a lot.
Thank you,
Have a
Eesha.
good
Thank you,
day.
everyone. Thank
Bye-bye.
you.